So this one is time bound. So if you are watching now, you better start doing this if you want to save in taxes. The purpose is to save and invest for retirement. This is a retirement nest, savings nest. It has a limit. However, there is tax deductible, just like the FHSA. So if you save, if you open it now before the end of February or first day of March, you can get tax deductible right off from your tax. All this can also be done in the traditional banking environment and the traditional financial institution. However, where we operate, we have some special benefits that goes with the kind of portfolio where we put all these funds. So if you go to the traditional financial institution to do any of these accounts, you might not be able to have these advantages, which I call the special benefits. Number one is estate benefit. Everybody knows what is estate. It's very important. Another one is creditor protection. The third one is maturity benefits. And the last one is privacy.
My name is Ukela Prince, and I'm thrilled and glad to welcome you to the Business Hub today. Today is a unique day and it's a blessed day. And continuing on this series on building black wealth for North America, I still have with me here today for another beautiful episode, Mr. Israel Iyamo. Israel, how are you doing, sir?
Thank you very much.
You're looking so handsome today, man.
You too.
I'm seeing, look at his haircut. He has one side part. This I haven't seen that before.
That's the part of financial freedom.
So follow that part, man.
That's the part of financial freedom.
Oh my goodness, man. But he has an end somewhere. So everything has an end, right?
Yeah. Life itself has an end. So you have to prepare for it.
Interesting. You look so handsome today. I'm seeing what is this?
Oh yeah, okay. Yeah, this the show of the financial contribution, the awareness.
WS what? National?
Yeah, World System Builder National Award. Recognizing the effort to put in educating families all over North America, Canada and the US. So this is a recognition of hard work and the 25 years experience that I've put into these helping families to make sure that everyone is okay and doing fine with the information that we are sharing, lifting up families and making things happen in our community.
Interesting.
So that's the award, yeah.
Interesting. Yeah. Well, you can see. Maybe sometime, what do I need to do to get this to?
Yeah, you have to be part of us in the campaign. You've already started.
I'm already part of the campaign, isn't it?
Yeah.
Okay. Now, today we'll be talking about. We are still on investment.
Investment.
Absolutely. And looking at registered accounts.
Yes.
Types. So we're talking about types of registered accounts in Canada, and also their differences. I can see you already have the board is here. So today we are in a lecture hall. So the lecturer is here, and the students, we are here to listen and also learn from this experience. So before you go to the to the board, maybe any intro on this?
Yes, so like we said, part of the financial foundation, the roof of the financial foundation is the investment. We'll be talking about part of the investment for a while now, the series. And before I continue, first of all, my viewers, I want to say Happy New Year. And this is going to be a great year and a year of solid financial information, financial prosperity to all. And by doing that, we need to pay attention to what we are saying. So if you have not subscribed, please subscribe. Don't waste time. Subscribe so that you get to more people in our community so that we'll be able to learn. So by way of introduction, we have the registered accounts here. And I just categorize them into two brackets, Group A and Group B.
Okay. So that's interesting. So viewers will be going to this lecture hall right now with Mr. Israel Iyamo, and I'm sure that I can see that this is very, very educating already. So, Mr. Israel, let's get it rolling.
Yeah, let's get it let's dive into it. Yeah. So, as we're talking about the registered accounts. This is specifically to Canadians.
Okay.
Yeah. So, in our next video, we'll delve into their the United States of America, but this is for Canada, right? Yeah. And I want you guys to pay attention because Warren Buffett said that the rule of money, there are two rules. The first rule is not to lose money. Then the second rule is remember rule 1.
Not to lose money.
Not to remember
not to lose money.
Remember rule 1. So we have two categories here, which I categorize the group A, the tax advantage. Remember we talked about there are 3 buckets in terms of the tax implication. We have the tax now, we have the tax later, and the tax advantage. But we just want to specific on this area. The group A is the tax advantage. I mean, I like to start with the most important.
Okay.
So if you ask me as a financial educator or financial professional, one way to grow your wealth is also to have an advantage, right? If you talk about the job principle, you increase your income and reduce your expenses. I know we've talked about how to reduce your expenses in the past, and we might talk about that later. So the first one is the FHSA. That's the first home savings account. The first home savings account. This is the first one here. In terms of the contribution limits, every year, this is quite new, it just started about some few years ago, about 2022. The government just put it up in place. The maximum in a year you can contribute is 8,000.
Maximum.
The maximum. So if you see, there's one thing that will be common in every registered account in Canada. They always have contribution limits because they know that because of the advantages that it has, the government do not want people to put all their funds there and they don't have any tax, right? But a lot of people don't know. So this FHSA, the maximum contribution is 8,000 in a year. A lot of clients reached out to me before the end of last year to take advantage of this. And if you max that 8,000 every year, you have about 5 years to reach the total limit. There's a total limit contribution you can't exceed.
And before within 5 years?
That's 8 times 5 is 40,000.
That's right.
Yeah. So your total contribution in the lifetime contribution for those that don't have any, that have not bought a house before. So if you have bought a house, sorry, you have missed that.
Oh, really?
Except you used it before. So 8,000. So if you max at 8,000 every year, the global limit or lifetime limit you can contribute is 40,000.
Okay.
That's for this 40,000.
Okay.
However, if you don't max it every year, you can contribute 1,000 or 2,000. Then you carry over the other. But the other year carryover cannot be more than 16,000. So if you miss 2 years together consecutive, you cannot carry above 16,000 in the subsequent years. Then for the purpose, FHSA purpose, like I mentioned, for buying your first home. So it's an investment you do when you are saving for your down payments.
Okay.
So the question is, why can't I just save it in my checking or savings account?
Yeah.
Your checking or savings account that you usually see in the traditional financial institution will not give you that. It's a tax now. Those are tax now. But this one, in terms of the tax purpose, is tax-free. Then it's tax deductible. Mind you, tax-free and tax deductible. Those are very important. Tax-free in the sense that it's not tax. Tax deductible means that if you contribute 8,000, like those clients of mine that, they were rushing to beat the 31st December deadline. That doesn't mean you can't start now, but you're supposed to contribute that maximum before December 31st. When they are going for their tax return now, this by March, this 8,000, a portion of that amount I've contributed will reduce their taxable income. So if they have made 50K for a per annum, for example, this 8,000 we play a form of tax deductible for that client. It's not absolute figure, but just to give you a simple understanding of how it works.
Okay.
Then the next one is the TFSA, tax-free savings account. TFSA. For 2024 limits is 7,000. However, every year, previous year before this last year, has a particular limit that the government usually puts. When they started, it's to about 5,000, 5,005, sometimes 6,000. So it depends on the government at that year. They will say, okay, we are increasing the limit for this very particular account. And you can only qualify to be part of this once the person is of 18 years. Same thing with the FHSA, must be 18 years and above.
Okay.
The difference is that this one is for the purpose of first home, while this one is just an investment nest.
Long term.
Then for the tax implication, because tax is also an expense, which a lot of people don't pay attention to.
Yeah.
And there's a lot of tax.
A lot of tax.
A lot of tax. If you are earning so much, you see the tax implication there. Maybe one day we'll look at virtual on how this tax thing. People, when you show some of them, they are shocked. Oh, this is what I pay. I say, yes, you don't know. Your money is leaking away.
It sounds like tax evasion.
So, no, it's not. So this one is a tax advantage. So the government is there for you to use. So if you evade tax, that's a criminal offense. Nobody's allowed to evade tax. So if you keep your money here, if you don't keep it here, that means you are not paid attention to where you can save money. So these are these little things that kill people. So in both of these, if you are looking at a short-term to medium-term investment nest, maybe your time horizon for investment is between 1 to 5 years, or thereabout, or 1 to 10 years, these two buckets will be the best. Because in this, you can withdraw at any time. There's no implication.
Okay.
You can deposit at any time. So if you want to know more on some other implication,
it could be for any purpose.
You can use it for any purpose, for the tax-free savings account. So there are other guidelines that is attached to this in terms of maximum contribution, if you contribute beyond that. But my viewers, if you want to know more, scan the barcode on the screen, or you click on the link to reach out to me for more information. I can have a one-on-one. Why this is just tax-free, this one is tax deductible. So for this one, you can withdraw at any time, but this you can't use it for any purpose. The only purpose is for the first home only. If you withdraw outside this first home, the tax deductible that you enjoyed initially will definitely drop back to you. You will not
Mr. Thank you for this. Is actually very educative, and we'll be going on a little break. So we'll be right back, viewers. So viewers, you just stay back and then stay tuned, because this is getting more interesting, right? So I'll see you soon. Welcome back, viewers. We are still on investment. And Mr. Israel, you've talked about the FHSA, which is the first home saving account.
Yeah, this one.
And we've also talked about the TFSA, which is the tax-free saving account. Yeah. Now, I can see on our board we have on the BPA we have the tax later. So let's dig into that.
Okay, quickly. This is time bound. If you're in Canada, the RRSP, which is the registered retirement savings plan, is time bound. Now, why did I say it's time bound? In every year, you can do your tax you can make contribution into this account 60 days into the new accounting, tax period, right? So this FHSA has a contribution limit of 18% of your previous year's income. So this one is only for those that have earned income. It's calculated based on your earned income. 18% of your previous year's income. So if you are just coming to Canada and you are working, you just start working today, you don't have any contribution limit yet. You don't have any because there's no income to base. But if you have worked prior year They use 18% to calculate. However, there's a maximum limit. It also changes, just like the way the TFSA changes. This for 2024 is $31,560 dollars. That's the maximum. That's the maximum. Okay. So if your 18% is above this amount, this is the maximum that you can contribute.
Okay.
So some people are earning quite well. So you can imagine 18% of somebody that's earning 200,000.
That's quite some amount.
Yes, that's quite some amount. But I mean, there are people that earn far more than that. So if they are 18% and they want to contribute to the maximum, it might be more than 31,560. But they can only contribute 31,560 for 2024. So this one is time bound. So if you are watching now, you better start doing this if you want to save in taxes. The purpose is to save and invest for retirement. This is a retirement nest, savings nest. It has a limit. However, there is tax deductible, just like the FHSA. So if you save, if you open it now before the end of February or first day of March, you can get tax deductible right off from your tax, your previous year's tax. Then it's also a tax deferred. Tax deferred in the sense that it's not tax advantage, it's tax deferred. It's when you are withdrawing, maybe at the age of 60 or 65. That's when the tax apply. The sense behind that is that now you are working so hard, your marginal tax ratio is high. You assume that when you are old and retiring, your marginal tax ratio will be lower. So you take it to that period.
Is there someone who has, I know we've talked about emergency funds and things like that.
Yeah.
Now, someone who needs to get something from this registered retirement savings plan before 60, is there a percentage that could be given?
You can actually withdraw from it, right?
Okay.
You can actually withdraw from, but if you withdraw before the retirement age, the tax deduction that was done before will be reversed.
Oh, really?
Then at a particular age from a 60, there's a percentage. It's advisable you withdraw at the ripe age of 65 or above. The more you keep it, the more you have the advantage of additional benefit that go, but it's also a tax deferred. The tax implication will come in, but so the tax deferred. So if you are going to withdraw, what you have gained before by way of deduction we go back. However, you can use this part of it. You can withdraw from this for down payment.
Okay.
You can withdraw from RRSP. In fact, this was the only account that was available before now, where people that have invested in RRSP can withdraw for their down payment. However, when you withdraw for down payment, you have 15 years period to return it back. You have to return it back within 15 years.
Really?
But you can withdraw tax-free.
Okay.
Just for down payment. If you are for down payment of first home, not somebody that has a house before. Okay. You can withdraw some amount there for down payments. However, you have to return it back because it's for retirement purpose.
Interesting. I wish we have more time.
Then the last one is the ROESP. This one is for Registered Education Savings Plan. It's for children. Government have a grant of 20% to the maximum of
2,500
or 2,500. But you can contribute more. But the grant is based on this maximum. So it's if you look at 20% of 2,500, it's $500. That's the grant government gives you as a form of to encourage you to save for your children's education, right? So it's meant, the purpose is for children's education and it's tax deferred. When the child is about going to college, maybe 18, 19, this tax implication.
So this comes as a grant.
It comes as a grant. However, there's a big difference. All this can also be done in the traditional banking environment and the traditional financial institution. However, where we operate, we have some special benefits that goes with the kind of portfolio where we put all these funds. So if you go to the traditional financial institution to do any of these accounts, you might not be able to have these advantages, which I call the special benefits. Number one is estate benefits. Everybody knows what is estate. It's very important. Another one is creditor protection. The third one is maturity benefits. And the last one is privacy. For me, the estate benefits, the creditor protection, and the maturity benefit is key. Because anybody can go at any time. and you don't want your money to be locked in probate. I kept on emphasizing that, my viewers. I kept on emphasizing because I've seen cases where people cannot access their funds, even though they have millions in account. And we need to be conscious of that. So this benefit, special benefit, is not available to your traditional financial institutions. That should be taken. So once that is done, then you are good to know that your investment is right.
Mr. Israel, there is so much you have to say.
So much.
But we don't have so much time.
Okay. So viewers, time is always very short.
Yes, time is always very short. So you can decide to even sponsor this, so that we have more time, where we have Mr. Israel to be part of this. So you have questions, to ask further on this, you just go to the comment section. You can drop your comments on the Black Community Canada television there. Or also, if you want some direct questions as well that you also want Israel to answer, you have the scan the code there. So thank you for being part of the Business Hub today on building black wealth for North America. We are thrilled and we are glad that you are part of this and you've been following us. So if you haven't, watched the previous episodes, please kindly just go to Black Community Canada television and make sure that you watch all the episodes that we've had from one. I think we've done about 10 episodes already. So I'm sure you won't regret that. Thank you for being part of today's edition.
Thank you.
God bless you.
Bye.
Cheers.